Hey guys, so today we're going to be talking about Chapter 6 of the Personal Financial Planning course. And I'll be working off the 5th edition by Chris Robinson. And in this chapter, we're going to be talking about the life cycle and financial intermediation. Although this chapter in this video is quite short, it is very important to understand as we move into more difficult chapters. So, people have a limited life expectancy, and during their lives, they go through stages of differing financial positions and earning power. We call the lifetime pattern of these stages the financial life cycle. Early in your life, you are totally dependent on your family for financial support, and your parents do the financial planning for the family unit. That includes you. You are focused on developing your human capital. So really, the financial life cycle for one person begins at the moment that they leave the home, that they leave and turn from a dependent to an independent unit of the family. Right? And so that's when the financial life cycle starts. Early in the life cycle, your consumption is likely to exceed your income at least some of the time. Maybe you have a student loan or are moving out of your parents' home. During this early stage, you have a lot of debt, right? So say, for example, you've finished up university, you've saved up for maybe 2 years at home, and you've decided to, take that savings and now go maybe buy a condo. Well, you're going to have to pay for that condo, so you take out a lot of debt. But that process of moving from a dependent lifestyle to an independent lifestyle does see a lot more higher consumption than earnings. And as you proceed through the life cycle, you start to earn more than you consume. So as you get a more stable job and you climb up the ranks in a company, your earnings exceed your consumption, and therefore savings are higher than zero. So earnings power peaks in middle age as the children become independent and debts are paid off. Okay? The essence of personal financial planning is arranging to meet the differences in earnings and consumption through borrowing and saving as appropriate. To some extent, you plan your life rather than each step. So essentially, if you understand the financial life cycle, you want to be able to plan ahead, look at the next stage, look at the next step of the cycle in order to determine, am I ready to move on to that cycle? Am I ready to get married? Am I ready to have children? Am I prepared for my retirement when my children move out of the house? So you're not only thinking about the present, but you're looking at the future. And so by thinking about your lifestyle through the financial life cycle, you're able to plan ahead. And you can actually group families into different categories in the life cycle. And there are actually 8 stages, which we'll talk about over here. So in the first category, you're younger and you're single. Let's think of it this way. So there are 8 categories. There are 8 stages to the family life cycle. And you think about it, a typical path. Say, for example, stage number 1, category number 1, you are at home, you are still living off mom and dad, you are deciding, you know what, I think next month I'm going to move out and get a roommate. Well, then you move into stage 1. You're young and you're single, right? So that's your first category. Maybe then you find a girl. You move in together, but you don't have any children. Well, you move into stage 2. Then as a couple, you might get married and you finally have children. So you move into stage 3. Or you have children and somehow you guys get a divorce. So you are single and now have dependent children. As you become older, and if you are still together with your wife or husband, then you become an older couple and your children become independent as they move out. Or if you were divorced, now you become older and are single and your children are independent. Then, same thing as before, you're moving in and you're now still a couple, but you're retired, or you're single and retired. So think of it on 2 paths. Either you're young, you find a girl or a boy, and then you get divorced, or you stay together. And so as a couple, you move from your dependent children to then independent, and then finally retirement. So you're single, no children, independent children, and then retirement, okay? And then you can actually expand the financial life cycle to look at maybe some personal financial elements. So budgeting, essentially that means, how do we save? How do we understand our expenses and our earnings? Income tax, the tax implications. Should I be focusing on, reducing my tax bill? Can I reduce my tax bill? Also risk management, debt management, investment opportunities. Should I be saving for the future? And also retirement planning. And so you'll see early on, say for example, for budgeting, if you're younger, in the younger stages of life, budgeting is very important. important because earnings and consumption will fluctuate, and sometimes they will exceed, or consumption will exceed earnings. And so you need to be sure that you are focusing on budgeting. Same thing with tax. Although the thing is, the income potential, the max earnings, as I referred to in the last slide, occurs at the peak age when your children move out of the home and you have a lot more disposable income. So income tax is not a priority when you're younger, but when you're in the middle of your life cycle. Risk, same thing. When you're young, you really don't have assets, but as you begin to accumulate assets, and most importantly, you have dependent children, then risk and debt management are important, and that's why you see that they're a high priority over here. Say, for example, for investment opportunities, early on, not as important. It's good to start early on, but it's not a priority. As you move and you maybe you get a partner and you have children, you begin to save a little more, but really the highest priority is pre-retirement, where you have that a lot of disposable income. The children have moved out, you have now this income on hand, and you're like, what should I do with this? Should I spend it, or should I start preparing for retirement? Should I put this aside? And that's really when investment is a high priority. And then probably the easiest financial element is essentially retirement planning. And so early on, when you're young, retirement planning is not a priority. But as you move and you become older and your children move out of the home, retirement planning is essential, and it is a priority. And so this kind of, it's a very simple proxy to use to really capture the financial life cycle of an individual, but it is also very helpful to understand the different needs and the different personal financial elements and their priorities at different stages. And so you'll see, as you're younger, you don't have as much assets, so from a risk perspective, it's much lower, but at the same time, the volatility of earnings, the volatility of savings is much higher. So you're dealing with a lot more different factors when you're younger, whereas when you're older, you have a much more stable income, much higher disposable income, and you're focusing more on the future. Okay? Now, focusing on financial intermediation. Well, financial intermediation is the process of transferring money from surplus economic units to economic units that have a productive use for the money. Intermediation takes place across sectors and over time. Essentially, what this means is that if you're taking a look at two productive resources, you're looking at one factory and factory number one and factory number two. Well, factory number one is producing a lot of profit and has some excess cash on hand, and factory number two needs capital to develop whatever equipment that they need to really achieve profitability. Then what you'll see, financial intermediation is essentially the process of taking that excess capital from factory one and investing it in factory two in order to really increase the productive use and the productivity of factory number two. And so financial institutions have emerged to act as intermediaries between all the different families and organizations that have money to invest or need money to consume. So when we're talking about financial intermediation, it's not just at the corporate sector. When we're talking about factories, it can be families as well. Say, for example, early on you need money to buy a home. Well, you need money, you take out a loan. Some of that money of that loan comes from deposits from older generations, maybe from people who are retired and have savings accounts. And so the bank will use some of that money to finance that loan, to finance that purchase. And so the financial institutions are the intermediaries which help and assist the flow of money between families and individuals at different categories in the life cycle. Okay? This book, the Personal Financial Planning 5th edition, covers the Canadian financial industry. And so the regulatory stance in Canada has been for specific types of products to be reserved for one group of companies, leading to the term 4 pillars. The 4 pillars are banks, trust companies, life insurance companies, and investment dealers. Canada has decided to reduce this separation a great deal, and both the Canadian and the provincial governments allow for more cross-ownership. And so there has been a huge consolidation in industry in the early mid-1990s and early 2000s, where you saw a lot of consolidation in the financial industry. I think the big ones that you could really reference to are the investment dealers and chartered banks. You saw a lot of investment dealers being acquired by chartered banks. You had Nesbitt Burns acquired by BMO, which is now BMO Nesbitt Burns, or CIBC acquiring Wood Gundy, and it's now CIBC Wood Gundy. So you saw a lot of the bigger financial chartered banks acquiring investment dealers to really offer a more comprehensive suite of financial products. Now, let's talk about the chartered banks. Well, there are two types of chartered banks. There are Schedule A banks, which are Canadian controlled, and most of them offer a wide range of products and services to the retail consumer through an extensive branch network. And these are essentially the big six, the CIBC, BMO, RBC, Scotiabank, TD, and National Bank. And then there's also Schedule B banks, which are much smaller and much more numerous, but most of them have no retail branches at all. Their business is concentrated either in the corporate and commercial sectors or particular ethnic communities. And so I think probably the easiest kind of bank to associate Schedule B banks with is Tangerine Bank. So you saw Tangerine. I believe they only have about 2 branches now, so they're very much more online focused. And so in this new digital era, they would much more fall under the Schedule B banks classification. Now, trust companies, well, their original business was to manage estates and special trust funds and to act as executors. Over time, they moved to provide services that banks also did provide. And you'll see that right now, trust companies don't exist anymore. They're not really that prevalent. There are some that still kind of operate, but I would say in the 1990s and early 2000s, the part of the industry consolidation in the financial sector was that trust companies, similar to investment dealers, were being acquired by chartered banks. And I actually took a little snippet out of one of the articles that I'll link in the comment description, talking about this consolidation in the trust companies industry. And so essentially, it says that the trust companies had expanded their quasi-banking operations. In the process, they became, in many areas, indistinguishable from banks at a time when the financial marketplace was expanding and changing rapidly in a very competitive market. So the expansion of trust companies in the 1980s really helped them develop their strength. And what you saw is that a lot of the time they expanded to compete with the larger chartered banks. But eventually, with poor management and loans that really kind of fell through, the trust companies and the profitability of the trust company industry really fell through. And so they were being acquired by chartered banks, usually just to stay in business or at least to protect existing capital. Okay? Now, investment dealers provide primarily investment services. Their main retail service is acting as an agent to buy and sell securities, shares, bonds, and other exotic instruments. And so there are not a lot of pure play investment dealers anymore. Majority of them have been acquired, but I think a good example would be iTrade. So you have the discount online broker that exists right now, where you can execute trades. If you're an online trader or a day trader, you can use the iTrade platform to acquire shares and buy on the Canadian, U.S. market, whatever market you're interested in. And so that would be an investment dealer. Although it does fall under, it is a subsidiary of a much larger organization. It would be considered a pure play investment dealer if it was owned and operated by itself. And in addition, like investment dealers, they can also manage your money and make investments using their own judgment if you wish, usually based on some general instructions you give them. So what you saw with a lot of the investment dealers that were acquired is that they didn't just offer trading services for you to make investments. They also offered wealth management services, private client services, in addition to institutional services. And so you saw that one of the big advantages of acquiring these investment dealers was that the chartered banks really solidified their position within the investment industry. Because before they were focused only on mortgages and financing mortgages and maybe term deposits and savings, but by acquiring those investment dealers, they really expanded their capabilities in the capital market space. Now, life insurance companies, another one of the 4 pillars. Well, the principal business of a life insurance company is offering life, health, and disability insurance for individuals. With premiums accumulating rapidly and payouts occurring later, they invest most of their money in the corporate commercial sector. Essentially, what this means is that they offer the three core services are life, health, and disability insurance. And so the premiums, the payments, the monthly payments that individuals make to buy insurance are then invested in order to really grow the money that they acquired, the premiums that they acquired. So when a payout does occur, when someone needs to claim insurance, they can really access a much larger pool of funds. In addition, they offer residential mortgages, a variety of RRSPs and RRIFs, and annuities. They compete with mutual funds and banks for the retirement investment market. So life insurance companies, not general insurers, but life insurance companies also offer mutual funds, which is quite interesting when you think about it, but they also offer annuities. Okay? The term mutual fund applies to both the company and the product it offers. A mutual fund is a pool of securities held by a company in which it sells units or shares in the fund to individuals. All companies previously described, except for general insurers, as I said, also sell mutual fund units. Some have their own products while others act as agents. So you'll see that life insurance companies, they sell mutual funds, but usually they act as agents, whereas chartered banks for sure now sell a wide variety of mutual funds. They also are in the ETF space, but we won't talk about that. Focusing on the mutual funds, which falls under the 4 pillars, it is now sold by majority of financial institutions and financial intermediaries in the Canadian industry. Okay. So now, moving on to the multiple choice. As always, I have 5 multiple choice questions. To get the answers to these questions, I will put the answers in the description of the video. So just make sure that you click see below to see the answers. And I'll just read out the questions. So number 1, which of the following statements concerning mutual funds is true? So A, B, C, D, E. 2, for a retired couple, which of the following elements of personal finance is of high priority? So this is a financial life stage question. For a couple with dependent children, which of the following is normally not of high priority? And this is another one of those financial life cycle questions. 4, Canadian financial institutions include which of the following? So this is a 4 pillars type of question. And then 5, a typical life insurance company does not offer which of the following products? And so this is more focused on insurance and understanding the difference between life insurance companies and what they sell and general insurers. Okay. Other than that, thank you guys once again for the support and the likes and the comments for the earlier videos. As always, if you are interested in finding out more about the textbook or actually buying the textbook, I have put a link in the description for you to go buy it on Amazon. In addition, if you are interested in finance and want to learn more about investing and how to analyze companies, then please do check out my research on Seeking Alpha, and I can help you guys over there learn more about that. Other than that, good luck with your course or with your studies, and have a great day, guys.